Now, there's been a lot of talk about these big tech corporations that are involved in AI winning out in this market bull run, in this AI bubble. As company stock prices are going up, people are placing their bets on what companies are going to come out as the winners and what companies are going to be left, competing for the scraps. I'm here to tell you that no matter which company wins out in the end, there is one class of companies, one class of firms that are going to absolutely, let me adjust my camera a little bit better here. There we go. That are going to be winning no matter what happens, and that is high-frequency trading firms. Now, there's obviously a lot of interest about learning about opportunities in trading firms among my follower base, among my viewers. So I wanted to sort of take a deeper dive into what it is that these companies actually do and why is it so competitive, not just for people trying to work for these companies to break in and actually work for these companies, but also why it's so competitive to just exist as a company in this space. Now, for the duration of this video, I want you to set aside your moral compass and just approach this with a learner's mindset, with a curiosity that'll let you understand why high-frequency trading firms have a valuable contribution that they make to the market. The way high-frequency trading firms make money at its core is by taking advantage of market inefficiencies that are very fleeting opportunities. Blink and you'll miss it. So they need to be very quick about grabbing those opportunities, quicker than human traders are able to work or act, quicker than a speed that human traders are able to operate with. Therefore, they invest in a lot of algorithmic trading, a lot of low latency systems using languages like C++ that are very close, that execute very close to the machine, that are very low-level programming languages, because speed is the name of the game. Let's talk about the bid-ask spread. A high-frequency trading firm will buy a tremendous volume of shares of, say, company A at a price called the bid price. And then they will turn around and sell off all of those shares of the same company at a price called the ask price. Let's say the bid price was $100. The ask price is going to be something like $100.05. Now, that is a very small difference. But the difference between these two prices is what gives these high-frequency trading firms the profit. The bid-ask spread is what gives high-frequency trading firms the profit. You do it enough times for enough shares, enough times a day, and you're raking in millions, hundreds of millions, even billions if you're in the leagues as companies like Citadel's, of profits every quarter. Right? So the reason low latency is super important here is because these opportunities are sometimes arbitrage opportunities. These opportunities are sometimes sniped opportunities, which are anticipatory. These opportunities are opportunities that these high-frequency trading firms will anticipate will exist in the market, and then they will buy out shares so that they can come in before a particular buy order is placed, and they can sell their shares at a higher markup than what this whale of a buyer would have accessed the market at. Does this offer any value to society? That's a tough question, but does this offer any value to the market? 100% it does. Think about it like this. Imagine if there was a company, Rashad XYZ, and you wanted to buy shares of this company. But there is only one holder of shares of this company, and you wanted to buy these shares as soon as possible. This is a situation in which the asset, the stock, is illiquid. You'd have to approach the person. You'd have to maybe go to a contractor, a broker of some sorts, and you're going to have to negotiate for a fair price for this company's shares. You know that this company is intrinsically valuable, but you're going to have to do an assessment and figure out what's a fair value to buy shares of this company at. Now imagine that you got these shares 6 months down the road. You're trying to sell off these shares again because you need the cash. But there simply isn't any buyers in the market that will take these shares off of your hand. It's not that these shares aren't valuable, there just isn't a price or the liquidity to support such a quick order placement and order fulfillment. This is what high-frequency trading firms or market makers are able to do. They trade in such tremendous volumes of shares every day that if somebody places an order to buy shares of a particular company, chances are the market makers are going to fulfill that order. If somebody is trying to sell shares of a particular company, chances are the market makers again are going to fulfill that order, and then they're going to pass it on to whoever else is willing to buy that share at a later time, a participator in the stock market who's willing to buy that share at a later time. There's a lot that goes into this, obviously. This is just the core principle that high-frequency trading firms are able to exploit, for lack of a better word, to make money. There's a lot of another way that high-frequency trading firms are able to do this algorithmically is by using a strategy called sniping or anticipatory trading, where they have AI systems go over their order book and go over signals in the market to predict that a big buyer or a big seller, for example, an institutional buyer or an institutional seller, your investment banks or whatnot, are thinking about taking a large stake in a particular company. They will read off these signals, and let's say if a big institutional buyer like Morgan Stanley is going to buy 100,000 shares of a particular company, they are going to preemptively come into the market, buy off those shares first at whatever price that they are trading at, and then they're going to sell off those shares to Morgan Stanley at a slightly higher markup. But at the volume at which Morgan Stanley is operating at, that translates to millions and millions of dollars of profit. Is that market making strictly? Maybe not, but this does translate to huge numbers in terms of profitability for these high-frequency trading firms. And the reason speed is the name of the game is that these market inefficiencies arise due to information asymmetry. Somebody knows something that others don't, and if you don't act on that information asymmetry quick enough, you're going to lose the opportunity. There's also arbitrage markets that these high-frequency trading firms take advantage of. Let's say in the New York Stock Exchange, thank you, whoever that was. Let's say Mr. Happy Stacker, thank you. Let's imagine that there is a particular stock that is trading at $100 in the New York Stock Exchange, but in the Japanese stock exchanges, it is trading at $90 for whatever reason. This is an arbitrage opportunity. A high-frequency trading firm, I mean, obviously the price differences aren't this drastic, but I am just exaggerating it for the sake of an example. A high-frequency trading firm will swoop in, buy a lot of shares in the Japanese market, in the Japanese exchanges, where the stock price is much lower, and then they will sell it off at the American stock exchanges, at say, the New York Stock Exchange, for a significant markup. And even though the individual share price differences are small, at the order volume at which these high-frequency trading firms operate, it can translate to tremendous amounts of profits. Now, I do want to talk about some crazy things that high-frequency trading firms have done in service of low latency. Citadel invested $300 million to build a line-of-sight fiber optics cable from their offices in Chicago to the data centers in New Jersey, because New Jersey holds the data centers for the New York Stock Exchange. Whatever is happening in the New York Stock Exchange, all of that information goes through the data centers of New Jersey. Why not build a data center in New York? Have you seen real estate prices in Manhattan? Anyway, New Jersey is very critical for the financial world because that is where the data centers of most financial services companies that are operating out of New York is based out of. Citadel knew this, and they thought that they wanted to be milliseconds ahead of the competition compared to the other high-frequency trading firms. So their solution to this was to build a line-of-sight cable, a straight line cable, from their offices in Chicago through to the data centers in New Jersey. How do you build a straight line cable? There's buildings in the way, there's mountains in the way, there are highways and trees and so many things between whatever place that the data centers for Citadel was in Chicago and New Jersey. They rented out roof space if this cable went through urban housing. They dug holes through mountains. They cleared trees so that they could have that straight line access to data centers and save themselves those fractions of milliseconds so that they could buy shares incredibly quickly and sell shares incredibly quickly and also be the first to jump on any potential arbitrage opportunity. Now, why is it so difficult to exist as a company in this space? Well, the first people that take advantage of these opportunities are the only people that get to enjoy these opportunities. The only companies that are able to take advantage of these opportunities are companies that have incredibly powerful hardware, that have the best algorithms, and that have the resources to execute on trades super quickly at lightning breakneck speeds. Why is it so difficult to get a job at these companies? Because they only want the best of the best. Their key investments, their capital investments, are in having a standing fund with which they can conduct these buy and sell orders. Their cash flow is essentially in the profits, and this cash flow is what they use to pay out their quantitative developers, their traders, and whatnot. But most of their capital expenditures is in getting the hardware they need to be able to execute on their trades at blindingly fast speeds. So they don't really need a big team of engineers to keep the lights on. And they're not in the business of keeping the lights on. They're in the business of dominating the markets, jumping on any opportunity before people even get a stench of any such opportunity. So you need a very lean team of hyper dedicated crack software engineers to man the ship. If there is an incident, if a system is down, you better be able to fix it immediately. A downtime is going to cost you any amount of downtime, like a couple of minutes of downtime, let's say in the order fulfillment system, is going to translate to hundreds of millions of dollars of profit. So the systems, the algorithmic trading systems that are built by these high-frequency trading firms are meant to be flawless. And the team of engineers that are building this are also meant to be able to operate under tremendous pressures, are supposed to be absolutely cracked, are not only just supposed to have their fundamentals down, they should be able to solve leet code hard problems like it's child's play. And that's typically why for a lot of high-frequency trading firms, you see engineers that come from math Olympiad backgrounds, that come from physics backgrounds, that come from backgrounds where puzzle solving and solving puzzles really quickly is a key skill. Anyway, the reason I wanted to make this video today is because I know that people are talking about who the winners are going to be, who the losers are going to be, particularly in anticipation of the Fed funds rate getting revised sometime by the end of this month. There's also potentially going to be 2 rate cuts this year, and that is definitely going to move the stock market, move the needle on the stock market. There's going to be a lot of buying and selling activity. And whenever there's buying and selling activity, market makers like high-frequency trading firms always win.